Stocks broadly are on track for a ninth straight week of gains, with the S&P trying for its first record close since January of 2022. My next guests are fading the bullish consensus, though, and see rate cuts coming for all the wrong reasons. Joining me now are Paul Christopher, head of global market strategy at Wells Fargo Investment Institute, and Joe Lavorgna, chief economist at SMBC Nikko Securities America. Welcome to both of you. It's good to see you. And Joe, I'll just start with you. What gives you the conviction to kind of stay on the glass half empty side of things these days?
Hi, Kelly. Nice to see you. Two factors. Number one, the yield curve, 2s, 10s, is still deeply inverted, basically now by a record if you look at daily data. So that's one factor. And related to that is the leading economic indicators, which are now down 20 months in a row, about 8% year on year. And those two variables, those two series have always been very predictive of recession. Okay.
And Joe, what about those who sort of say, listen, yield curve inversion, post-pandemic, it's a different kind of cycle. We've been through manufacturing recession. We've been through a housing downturn, but they're not all lining up, and we're going to get through this without the economy experiencing a down business cycle.
That is possible, but if that were to happen, Kelly, the yield curve is so inverted that the Fed has to cut 100 basis points more than what's even priced into the market. If that curve stays inverted, even though yields have come down, you will continue to see banks tighten their lending standards. So credit availability will not be present if that curve remains inverted. So if the Fed cuts massively and aggressively, maybe we get the soft landing. But the market's saying we're going to have a bumpier landing than what people think.
It's so interesting, too, because from that point of view, it would argue for massive Fed action here. And instead, everyone's kind of talking about them taking a victory lap. Kind of related to this, gentlemen, just hold on for one moment. The 5-year auction top of the hour, the results are in for that. And we've seen bond yields continuing to sink towards their session lows. Steve Liesman is following it for us. And Steve, if you can, tell us what the action was, how to go down.
I mean, I think it's a decent auction. We'll wait till Rick comes back next week to put a grade on it. But I have the dealers at 14%. That is below last time, the 11/27 auction, which was 16.8. I've got the directs at 15%. Let me double check that, 15.4%. That's below last time. And the reason is the indirects, pretty strong bidders here, 70% versus 65% at the last auction. And that is above, by the way, that is above the 6 auction average, which was 67%. Bid to cover 250, above the last auction at 246, but a little bit below the 6 auction average of 252. So I think it's a good auction. I'm not seeing any action in the Treasury, Kelly, here that makes me think it's a bad auction. The high bid was 380, and the Treasury at the 5-year at the time was trading at 381. So we'll let smarter people like Joe Lavorgna tell me if this was a bad auction, a B auction, a C auction, or a D auction. But from what I can tell on the way the market is behaving, it looks like the government was able to sell something like $58 billion in 5-year paper in a not too shabby way.
You know, Rick better watch out, Steve. I think you're doing a great job with these. So I'll turn to Paul Christopher.
No. Rick can have that job. He knows what is good and bad. I'm going to give this a B minus because the bid to cover was below the 6 auction average, but it was still not too shabby. And again, this is $3 billion higher than the last auction. So
exactly.
The government keeps pacing this paper, and people keep paying relatively low yields. I did go back and check. The last time we did a 5-year auction, they sold it at 441. So do the math. At 380, that's 61 basis points lower than the last time we were at this. So I don't know. Seems pretty good to me.
I think our deficit problems are solved with that. Paul, let me turn and Steve, stay with us if you will. Paul Christopher, I think the verdict from just look at the 10-year, which just so our audience knows what that chart is showing, is below 380 now, so about 3.799. That's a pretty clear verdict that the market is more and more at peace with the way that the Treasury supply is being taken down, I think.
Yes, absolutely. And great to see you again, Kelly. It's a remarkable decline in the 10-year yield, really in longer term yields across the board. But bought at the cost of what to the Treasury? If you're going to sell a whole lot more short term paper bills at higher rates, and then you have more spending coming online next year, how are you going to continue to finance that much of your debt at these short paper sorts of percentages? I think you're going to have to move more into those longer dated treasuries. And at that point, those bid to covers are going to start to increase again. And that's when you're going to start to see yields rise with questions for the stock market.